Hey, it's Mike Lynch with AmeriFirst Financial. It is Tuesday, and it's time for your Monday morning update for the week of May the 30th or the 31st. If you worked yesterday, then your week started yesterday. If not, your week started today like mine. So hope everybody had a great 3-day Memorial Day weekend. Thank you again to all those that sacrificed and the families that sacrifice and continue to sacrifice for our freedom. We wouldn't be here today without you. So what happened last week and what's happening this week? Actually, the market improved last week. We saw a 55 basis point improvement in the market, and inflation was up, spending was up, and that should have really moved rates up, but it didn't. A Fed member, one guy made a comment that the Fed should stop rising interest rates. That coupled with the short market, because the bond market was basically closed a half a day on Friday. Let's look at the chart here. This shows you, and I've shown you this many times, this shows you a trading of mortgage-backed securities in the bond market. And this just goes back to March. I can make this go back 6 months. And really what you're seeing here is a trend of the market getting worse. And so what we know is that when money is invested, it's invested in the safer bond market or the riskier stock market. And when everybody feels great about the economy and everything's moving forward, money will flow out of the bond market, which it's representing here, into the riskier stock market. Market goes up, the bond market goes down, the stock market goes up, and that means mortgage rates go up. So we have seen this trend, obviously, for quite some time, since November of last year, for a lot of different reasons that I've discussed. But basically, this gives you a visual that this bond market trading is going down. Whenever we see the red, that means money's flowing out of the bond market and mortgage rates are going up. Now, you see a lot of green intermixed in here. And each one of these bars are called candlesticks because they look like they have a little wick on them. So when you see the green, that means rates actually are improving or the market's improving. And if we go back just to the last month, you can see, or the last quarter, you can see that just in the last week, we had a nice improvement in that bond market. And as I said, inflation was up, spending was up, and that really should have moved rates up. But this Fed member said that we should stop raising the Fed fund rate, which doesn't affect mortgage rates. That just affects equity line rates, car loan rates, credit card rates, the rate that businesses use to borrow money from each other or money for their businesses. And so that kind of curved the market. Plus, we had a short week, so everybody parked the money in the safer bond market, which typically happens when we have a long weekend, just in case something weird happens. They don't want to take risk, so they park it in the safer bond market. But today's a different story. The market actually opened lower, and you can see up here in the top right, we're 41 basis points down. So we were 55 basis points up last week, and we're down almost all of that just in one day. So let's talk about what is going to move the market this week. I always talk about three things: the Fed, jobs, and economic data. So I've talked about this term called quantitative tightening. And basically what that means is the Federal Reserve is going to purchase fewer mortgage-backed securities and treasuries. Now, the Fed has been pumping billions of dollars into the bond market since COVID started. We know that, and that's why we rode those 2.5%, 3% interest rates. In October of last year, they started buying fewer mortgage-backed securities, which is where mortgage rates are determined in the graph I just showed you. And they basically stopped buying these in March of this year so that they could raise the Fed fund rate, which they have. They've raised it 0.75 of a point. And in June's meeting, they're probably going to raise it another 0.5 point. And they're even talking about in August meeting raising it another 0.5 point then. And they need to do this. Why? To fight inflation. The other side of this is they're going to start buying fewer treasuries. And this quantitative tightening means that they're buying fewer treasuries on the back end, meaning they're not investing on the back end of the bond market, which is going to drive those rates up. Now, the bond market has not priced in this yet because the Fed hasn't given any clear direction on when they're going to really start buying fewer treasuries. Will the Fed give some insight this week? Probably, because Next week, they have to go for a couple weeks. They have to be silent. They can't say anything leading up to that June Fed meeting. So it's expected this week, because of this quantitative tightening we know is coming. They've already said they're going to do it. It's expected to put some downward pressure on the market, and we could see rates start to move higher. Really, probably in the next 2 to 4 weeks, we're going to see these rates move higher as they start to really push this quantitative tightening. So what's the Fed going to say this week? What's their position? We're really going to be paying a lot of attention to that, because that's the next shoe really in these rates going up. The first one was stop buying mortgage-backed securities so they could raise the Fed rate. And the next one is the quantitative tightening, which they're going to stop reinvesting, or really slow down their reinvestment in the bond market by slowing down their treasury purchases. Second thing is jobs week. A lot of jobs reports coming out this week, and it's packed into 4 days because Monday obviously was a holiday. Interesting statistic, there are 2 jobs for every person that wants a job, about 10 to 11 million unfilled jobs in our country right now. And it's a real problem because nobody can really figure out why nobody is taking these jobs. Even though the unemployment rate is down, they're not counting people that aren't looking anymore. So even though we're going to see lower unemployment rates, the fact that these jobs aren't filled is a concern. And this is really leading us into more recessionary pressure. Another sign of a recession coming is low unemployment. Thursday, the jobless claims are coming out, and then Friday, non-farm payroll. So we're really going to pay a lot of attention to what those jobs numbers look like at the end of the week. And then the third and final thing is economic data. So a couple things here. A couple weeks ago, the New York Fed and New York manufacturing and Philly manufacturing, Philadelphia, they come out with their manufacturing numbers that say, hey, how well are businesses producing? Are they manufacturing? Are they making stuff? And those numbers are really down, which is a sign of a recession coming. The national manufacturing numbers are coming out this week. Are they going to be the same? We're going to pay a lot of attention to that. Are businesses making less stuff? Is it because there's less demand, or they just can't get the stuff from overseas? Another data point is oil is $118 a barrel. The EU is buying less oil, and China now has taken off a lot of the restrictions from COVID. They shut down Shanghai. They're starting to loosen some of that stuff up. Now they're buying more oil, and oil prices are going up. This is going to push pressure on gas prices. They expect to go up, and this really is inflationary. And we know that inflation is just a bad thing for rates. And then finally, I want to show you some other stats that came out on home prices and home valuations. So the first chart you're seeing here is the FHFA, which is the Federal Housing Finance Agency. Every month they come out with a home price appreciation on single family homes that use conforming loan amounts. And month over month, 1.5% appreciation on home prices, and year over year, 18.7%. So just in the last year, we've appreciated, if you look at FHFA's number, almost 19%. I mean, we know that is just such a high number, and it shouldn't be any surprise to us. But just over the last month, we've still seen appreciation. And this is for March, so it's always a couple months behind. Rates were up in March. We're going to obviously want to see what next month's numbers look like. That'll measure April, and the month after that, it'll measure May, because we know these rates have been up, and that probably is having an impact on prices. The Case-Shiller, another report that came out today, shows the appreciation. It's really the gold standard that shows appreciation in property. 2.6% appreciation in the month of March, month over month, and 20.6, almost 21% appreciation year over year. So again, shouldn't be a surprise to us, but just shows you how strong this market is, how it's not slowing down, and we all see that when we work with our clients and that are trying to buy houses. So what's happening this week? Really, we're going to see more pressure on rates going down than going up, and we're really focusing on how much they're going to go down rather than how much they're going to go up. I'm sorry, more pressure on the rates going up, more pressure on rates going up and the bond market going down. So we're going to see more pressure on rates going up than going down. It could be a tough week on rates, really leading into the end of this week. So we're in a very cautionary float position today, with a quick trigger to move to a locking position if we see the market move in any way. If you have any questions about locking rates, have clients that have any questions, Don't hesitate to reach out to me. If you know somebody can benefit this video, please forward it to them. Have a great, productive, short 4-day week, and we'll talk to you soon. Bye-bye.